Alright everybody, welcome back. In this video, we're going to talk about trend. Now we're going to start with this video, but there's very likely going to be more than one. In this video, we're going to look at the big picture trend, so we're going to focus on identifying the long-term big picture trend. Okay, so with that, what we're looking at here is the 50 moving average and the 200 moving average. When the 50 is above the 200, we're in a bullish market. And when the 50 is below the 200, we're in a bearish market. The problem with that point of view, if we just make it just as simple as that, is there are a lot of shades of gray along the way, especially when you get into the higher time frames. So in a bullish trend that's failing, you're going to see close below the 50 but above the 200, even though the 50 is still above the 200, right? So remember, 50 above 200, we're in a bullish market, but that bullish market can be failing. It all depends on where the close is, but the 50 would always be above the 200 in a bullish market. All right, so then when you get closed below the 50 and below the 200, but the 50 is still above the 200, that is still a bullish trend because the 50 is above the 200. But we would say that that bullish trend is dead, right? Or that it's failed. But we can't take the words bullish out. All right, so I'm going to show you examples of these. I left this up while I was talking so that you could take a picture. Now we're going to get out of that and just keep going. The whole idea is, how do we classify a trending market or not? So this classification uses declarative sentences. And we're going to come up to color coding in a little bit later. Let's just jump past that for now. And I want to show you some pictures. So here we've got a bullish market, right? It's a bullish trend. In this bullish trend, we've got the 50 and the 200, and we have price above both of those. It's an obvious, very clear, very simple bullish trend. I don't think anybody would argue with that message. Here we have a bullish trend, but it's failing. The 50 is still above the 200, but price has broke below the 50. All right, that makes sense. We can see the structure. Here we still have 50 above the 200, but price has crossed down below both of those. I don't think anybody would say that this is a bullish trend. However, because the 50 is still above the 200, that's what it would get as a label. It would still be labeled as a bullish trend. So we need a way to expand beyond just bullish trend and bearish trend. That's not good enough. We also need to distinguish where it's at. Is it improving bullish trend? Is it failing bullish trend? Or has it completely failed? Right now, this one, I like to say that it's an improving bearish trend. But we still need to put the word bullish in there somewhere because the 50 is still above the 200. So the way that I write it is that it's a failed bullish, improving bearish. And that way it still has that bullish word that matches 50 being above the 200. But it recognizes that the bearish trend is improving with price being below both of those major moving averages. Down here, we've got a full-on bearish trend because the 50 is underneath the 200 and price is underneath both of those. And then here we've got a bearish trend that's failing, and that's because price has come back above the 50 but is still underneath the 200 when the 50 is underneath the 200. And then here we've got an improving bullish trend, but we still need the word bearish in there because the 50 is still underneath the 200. So the way that I like to write it is I will say that it's a failed bearish trend and it has an improving bullish trend. And it has to have that word bearish because the 50 is below the 200. All right, so that's the way that I use those declarative sentences. Right? We have to use those declarative sentences because when we're looking at trend, when we're analyzing a chart like this, we're not trying to predict the future. We're not even trying to determine what's going to happen next. These aren't the tools that we would use for that necessarily. All we want to use these tools for is to make a definitive statement and to plainly speak what we have right now. I think this is where a lot of traders make a mistake. They try to do too much with the tools that they have, and they're overreaching. They're using the tools in a way that they were never designed to be used. Right? These are not forward-looking indicators. At their best, they can tell us what we have, but they're backwards looking. Right? So they're going to tell us what we've had more than what we have, and they're certainly not going to tell us what we're going to have. Right? This is really important to understand. All of us, including myself, will look at something and we'll reach ahead and say, well, it looks like it's going to, continue lower. It looks like it's going to continue to go higher. But really, these are not the tools we want to use for that. Right? And we should not do that. All right, so now that I've shown the pictures, I kind of jumped ahead a little bit. I want to back up to this area and kind of just put this picture back up and finish talking these out. Bearish trend is improving because close went below 50 and 200, but the 50 is still above the 2. And then bearish trend itself, just a full-on bear trend, closes below the 50. 50 is below the 200. And when the bearish trend is failing, price managed to get back above the 50, but it's still below the 2. And the 50 is still below the 200. And then we've got a bullish trend which is improving, and that's when close has managed to get above the 2. It's managed to stay above the 50, and we've got the 50 not yet above the 2, or I say 2, but I mean 200. All right, so that's the classifications that we want to use. From that, we want to go a little bit deeper and start thinking about colors. Now, I just did a pivot video where we talked about the line colors. The line colors can help you get rid of the words that you have to use when you're drawing your lines, right? You don't have to use labels saying monthly level, quarterly level, weekly level. And when you don't have those words and you just have the colors, your charts are just so much cleaner. It doesn't have all that clutter. And the color is a recognizable thing. Your brain will recognize those colors, especially once you train it. So then you'll recognize risk sooner. You'll be able to perform analysis faster. It's just a really great way to do business. The same thing is with moving averages. You want to unify all of the ways that you perform analysis. And that way, if you jump to different brokers or if you go to different charts or chart setups, that your colors still make sense to you. And this helps resolve that issue where you show up at a chart and you can't remember what the moving averages are, and then you got to go hunt them down and try to figure out what's that color, what moving average is it. If you always have the same color on the same moving average, whenever you see that color, you'll know exactly what you're looking at. So for an example, for me, my moving averages are always these numbers, and they're always this color. My 50 is always orange. My 20 is always green. By doing it this way, I can instantly recognize a moving average and know exactly what the number is that goes with it. I'm going to add one note here. These colors and these numbers are not some must-have thing. You don't have to do what I'm doing. You can use, say, a 21 period moving average, an 8 or a 12 or a 54. You don't have to use the numbers that I use. And you don't have to use the colors that I use. But you do want to sit down, grab yourself a cup of coffee and a pen and a paper, and just write out the moving averages that you use on a day-to-day basis, and then assign them a color scheme so that you become more unified and are uniform in your analysis. All right, now another note is the line types. So as we're going to discuss here in a little bit, I use SMA and I use EMA. Well, if I have two purple lines, one 200 period SMA and one 200 period EMA, I need to distinguish between those two. To do that, I always make my SMAs a dashed line, and I always make my EMAs a solid line. And that helps me distinguish the two. You can do this in any way you want, right? I'm not saying that you have to do it this way. Maybe you have a broker that doesn't have dashes, but it might have dots. Okay, do that. If you're using a platform that doesn't have dashed lines at all, but lets you make one thicker than the other, then do that. Do something that gives you an opportunity to change the line style, even if the color happens to be the same. And that way you can distinguish between your SMAs or your EMAs. And really, when you think about it, there's a lot more moving averages, right? There's the whole EMA, the SMA, the double EMA. Oh, there's so many different kinds. So you need a way to distinguish those. When I use a dark chart, my 4-period moving average is white. But if I go to a white or a bright colored chart, then my 4-period moving average will be black. That's the one that changes for me, and it just depends on the background. And then I leave the yellow as a stand-in. Basically, if somebody asks me to look at a chart with a moving average that I don't use, say like the 100, I will turn the 100 into a yellow moving average, and it will remind me that that moving average does not belong on my chart. And that way, if I see it later on, I instantly know, oh yeah, that's not one of my moving averages, and I can take it back off of the chart again. All right, so another thing about recognizing trend is when your moving averages are fanned out and stacked nicely. If you look at a chart and all the moving averages are clustered together and they're all just knotted up like Jenga or spaghetti, then that's not a good trend. That's a trend that is transitioning, and it's just a mess. Call it what it is, recognize that there's nothing there, and that you have to wait for the market to give you something. Don't try to distinguish if it is just slightly beginning to poke out of that nasty mess, and you decide, oh well, it's good enough. It really isn't good enough. You want clear, distinct trend with a very wide fan. The wider and the clearer the fan, the better, stronger the trend. All right? So the next thing that we want to talk about when it comes to trend is the time frame of the chart. So I'm going to come back down here again for a minute, and we're going to look at a chart that I've got that is a monthly chart. Let's see if we can scroll down here. 2 hours, 60 minutes, monthly chart. This monthly chart goes all the way back to 1998. Can you imagine? All the way back then. And in all that time, it never got above the 200 period moving average. So this entire time, it's been in a full-on bear market. There has been occasions from time to time where price did get above the 50 for brief moments in time, right? And when that happened, we had a weakening bearish trend. Now, in 2022, we actually managed to get across the 200 period moving average. It's the first time that this has happened in over 2 decades. When we talk about a long-term trend, this is a long-term trend. And along the way, there was opportunities to be bullish, to be bearish, to be sideways. There was extreme price changes, and yet consistently we were in a very solid bearish market. Now we're in a transitioning market. This transition could take 2 or 3 years before it's fully established. And then the long-term outlook could be bullish for years to come. I mean, who knows how long this could last, right? The only thing that would break it at this point is if the Fed come out and made drastic changes to the rates, right? Because this is a yields chart. Other than that, this thing, analysis-wise, shows that the long-term trend is transitioning into a bullish phase, and we could see decades of bullish trend. So when we talk about a long-term trend, this is the greatest example that I could ever show of what that looks like. Now here, when we go up to something like a weekly chart, that weekly chart has been trending for a long time too. In all of 2022, this is a weekly chart right there, we've been above both of these moving averages for all of 2022. But we didn't get the 50 above the 200 until sometime around March or April, maybe into May, right, for a solid confirmation. So for more than half of a year, we've been strongly trending in a bullish market. This is very likely going to continue for a long time. Look how long it took to transition when we got below all of this. It took years before it finally started to turn around and begin going up. And it could drop back down again. This transition, it could take a long time. But remember that bigger picture chart. It's the same ticker symbol, this weekly and that monthly. So, it's going to be a struggle or a fight. But as long as this is maintaining above that 200 period moving average, we're going to continue to call it a bullish trend, right? So trends can last for a long, long time. And the numbers on your chart is going to explain that long-term trend to you. If you're on a 5-minute chart and you can look back over the last 3 days and see that you were in a bearish trend and now it's turning over and you're crossing over into a bullish market, how long do you expect that trend to last? A day, maybe 2? Sure, if it fully forms across, it could last a day or 2, 3, but it's not going to last for years, not from that chart time frame, right? So just some perspective on the time on our chart mixed with the size of the moving average. Put those two together and you really have full control over the strength of the market that you're analyzing. One more thing about moving averages is how the number changes based on the chart you're on, and yet it might equal the same thing. A great example of that is a daily 50 and a weekly 10. They're not perfect. They're not going to line up right on top of each other, but they very often represent the same area or the same zone on a chart. So if you're on a daily chart and you bring up a 50, you would think you're looking at a pretty high moving average, right? I mean, it's a 50. That's a pretty strong, pretty high up number. When you go over to a weekly, looking at a 10 weekly is like looking at a 50 daily. So if you did look at a weekly 50, then you're looking at, a much bigger, much stronger trend number, right? And it's very likely going to hold for, weeks and weeks. You look at the time frame that you're on, and you look at how it's been reacting, how long it took for it to transition last time, or maybe even the time before that. You can look back and see how long the trend has been in place, how long the transition has been taking place, and you can kind of get an idea of how long the new trend might last. It's a question that I get all the time. How long do you think this trend is going to last? And when I ask, what time frame are you looking at? 5 minute. It probably is going to last, maybe an hour or two. I don't know. When did it begin? How long did it last time? Okay, so another question. Should we use the EMA or should we use the SMA? I use both. When it comes to the 50 and the 200, I use both. And the reason I do is because the people who use SMA, that they choose to deliberately only use the SMA, you're not going to get them to change their mind. They're going to continue to use it because that's what they like. Half the people that choose, that's what they pick. The other half who actually pick, choose the EMA. And they're not going to change. They won't change their mind. It's what they want. So for those of us who don't care, we need an answer. Which side are we supposed to keep track of? Well, since it's evenly divided, there really is no edge in trying to pick one over the other. So I long ago decided that I would look at both. In the lower time frame moving averages below 50, I almost always use an EMA. There are occasions from time to time where I will use an SMA, but this isn't really the video to get too deep into moving averages, other than how much I needed to talk about them to get back to trend. All right, so EMA versus SMA, if you ever question that, ever, no matter what time frame you're on, no matter what moving average number you use, if you're thinking, gosh, I don't know, maybe I should use the EMA. No, maybe I should use the SMA. Forget it. Put both of them on, solve the problem, and just leave it like that. Because when in doubt, we need to get a definitive answer. We can't live in this gray, wishy-washy state where we just don't know for sure what we want to do. That does not work. All right, so make a decision, be firm about it, and move on to the next thing. So we're going to start with the analysis on this chart right here. This is the TNX. We're on a weekly, and I've got the 50 and the 200. What we want to recognize is that the 50 and the 200 are far apart. They are fanned out nicely, and that price has been maintaining above that 50 and has not yet, even once, come down and actually touched that 50. This is a bullish trend, and it's a strong bullish trend. We know it's strong because it hasn't even tested that 50 one time, and we know it's strong because the 50 is spread out nicely away from that 200, and both of those are pointed upwards. It would be a little stronger if the 200 was pointed just a little more sharply upwards, but we don't have to have that, right? That would just be a little stronger. It'd be a little better. We don't want to look ahead and say, well, I see the left shoulder and the head. We're probably going to get a right shoulder, and then we're going to get a bearish market. And we don't want to look ahead and say, oh, well, see, it's been declining for 5 weeks straight. We're in a bear. Don't do that. This isn't the chart to make forward predictions. This is the chart to discuss what we actually have right now. What we actually have is a strong bullish market. In a lower time frame, we can start to focus on what we think could happen next, right? But with what we have here, this is a strong bullish market. Now in the next one, we're still in a bullish market because the 50 is above the 200, but this bullish trend is failing. It's failing because we're below the 50, and the 50 has started to curl over. It's moving back towards the 200. So price is moving to the 200, 50 is moving to the 200, and that tells us that this bullish trend is failing. It hasn't failed yet. We're still in a trend, in a bullish trend on the daily time frame, but this is a trend that is failing. Here we've got the XOP. I had to change charts to find one that would give us an example of what we're looking for. So here, price has broke below both moving averages. The 50 has turned over. The 200 has just slightly started to point lower, and yet we're still in a bullish trend because the 50 is above the 200. But we really couldn't call this bullish, right? I mean, if I look at this, I don't think bullish. But we can use the word bullish and just put the word failed in there. So we can say this is a failed bullish trend, and it's an improving bearish trend. We have to have that bullish word because we have 50 above the 200. We would consider this a bearish trend because price is below the 50 and price is below the 200. But that bearish trend, it's just getting started. It's kind of a young bearish trend. It really hasn't established itself really well yet. We want to see that 50 get below the 200 period moving average, and then we would have a good bearish trend. All right, so here we have a 2-hour chart, and this is a fully bearish trend. We've got 50 below the 200. We've got price below both of those, and the moving average is sloped on the 200 and it's sloped on the 50. This could be more bearish if the 200 was pointed more to the downside, but we don't have to have that. It's okay the way it is. Here, I've got the TNX on a 60-minute, and that bearish trend is beginning to fail a little bit. We've crossed back above the 50, and that means that the full-on bearish trend that we had has lost its meaning, right? We don't have that anymore. If it was to drop back below the 50, then we would still be in a bearish market trend. The danger is, now that we're above the 50, we could focus on getting back above that 200. And that's what we have here. So here, we've got the TNX. We're on a monthly time frame. We've got price above the 50, price above the 200, but we don't yet have the 50 above the 200. This is an improving bullish trend, but we have to use the word bearish. We have to get that word in there somewhere because 50 is below the 200. So we say that it's a failed bearish trend and it's an improving bullish trend. We have to keep our words consistent in our analysis, right? With the 50 below the 200, that's bearish. We have to put that bearish word in. One thing that you might find helpful is to write out your declarative sentences. Have them attached to a chart that you can use for examples, and then you can just bring that chart up and you can say, oh yeah, this is my example of a bullish trend or a bearish trend or a bullish trend that's failing, right? Or a bearish trend that's improving. Once you get used to using that language in a declarative sentence, your analysis becomes cleaner and sharper. So, in broad terms, bullish trend is when the 50 is above the 200, and that's that. And you can add to that if the close is above both. A bearish trend, the 50 is below the 200, done. That's a bearish trend. But you can improve on that if you were to say, and the close is below both. Anything that is not one of those two is a market in transition, right? So if you have a bearish trend with the 50 below the 200 and price below both of those, and then it turns up, like we were talking about earlier, anything that's not this bullish description or bearish description is a transitioning trend. It's a transitioning market. There are traders who say that they want to be cautious and they only want to take the best setups and they want the cleanest, highest probability stuff. That would be these two descriptions right there. And anything else is a market in transition. It is a more risky proposition, right? There's no better way to distinguish that than to be declarative and specific. For multi-time frame analysis, this is where you can really deep dive into things. In the picture below, I've got the hourly, the daily, the weekly, and the monthly. If you were to see a bullish signal on all four of those time frames, then you know you're looking at a bullish trend that not only has been going on for years from your monthly, but maybe for the entire year on your weekly, and for the last, say, 6 months on your daily, and within the last 2 weeks on your hourly. That every single time frame is telling you there's a bullish trend. And how long is that bullish trend supposed to last? Well, according to the monthly, it could last for years. And on the weekly, it could last for months. So, putting that time frame together is really how you start to write out your analysis, by using those declarative sentences. I really hope that this video has kind of opened your eyes to a different way of approaching technical analysis. And this is the first video in a number of videos that we're going to do on trend and on moving averages. Consider this one just the introductory video, right? The beginning of the conversation. There's a whole lot more that we want to get into, including using pairs. We always want to use pairs, right? Not just one moving average, but multiples. Always. One eye, you can see, you can look around, right? If you have just one eye. But you won't have your depth perception with one eye. You need two eyes for that. With a moving average, sure, one moving average is good. You can get context, where price is in relation to that moving average. But with two moving averages, you have depth, right? That's where you really get to apply character to your analysis. Remember, declarative sentences, you're making a statement of fact. Be specific with or be consistent with the numbers that you use, the moving averages, and be consistent with your color types. There's no wrong way to go, and it might take you a little while to even just decide what numbers you want and what colors you want. But once you make that decision, stick with it. Don't change it very often. Every once in a while, you're going to find that you might need to make a change. It's okay. It happens to all of us. Make that one change and then stick to it again, right? Don't keep changing things around. I appreciate your time, guys, and I look forward to seeing you at the next video.